Alhambra CEO Joe Calhoun talks about when interest rates may peak.
Yeah, Bob, I was talking to a client the other day, and we're talking about the markets and stuff. And I got to talking about interest rates, and we talk about the 10-year Treasury rate. That's the rate that we think is, kind of the most important one that we watch. And explained to him, I was saying, look, I think rates are near a peak, and he said, why? And I went on to explain to him on the phone about nominal GDP and how nominal GDP and the 10-year Treasury rate tend to track each other and so forth. But it occurred to me it was kind of a hard thing to explain over the phone. It's better with visuals. And so I thought, well, maybe I should do a short presentation about this, just to let people know how we come up with things like this. Look, I think the important message here is we're not just guessing. There actually is a process. When we say we think rates are near a peak, there's a reason why we're saying that. So I want to get into that about why we think that's true. We're going to talk about nominal GDP, potential GDP, and inflation. So what is nominal GDP? Okay, well, when you hear people talk about, hey, the economy grew 2% last year or 3% last year or whatever the case may be, what they're talking about is real GDP. And real GDP is about how many widgets did we make and sell. Nominal GDP adds in a price factor. It not only is about how many widgets did we make, and actually when we're looking at GDP growth, we're looking at how many more widgets did we make this year than last year. But nominal GDP includes the change in price as well. So that's what nominal GDP is. And you can see over here on the right-hand side, nominal GDP has been falling. That's because inflation has been falling. And you'll see in a little bit, real GDP has actually been rising again. So now let's add the nominal 10-year Treasury yield in here. And you can see that the nominal 10-year Treasury yield and the nominal GDP growth, and this is year-over-year change in nominal GDP, that it tracks pretty close. Now, look, there's a chicken and egg thing here. Do rates track nominal GDP, or do rates have an impact on nominal GDP? And the answer to all those things is yes. There's no way to kind of disentangle all that. The bottom line is, though, that these things do track each other very closely over time, and we know that they do converge over time. So a couple of things I want to point out on this chart, though. If you look over here in the 60s and 70s, you see that we had growth of nominal GDP was consistently above the 10-year Treasury rate, except for this period right here in 1970. This was a recession in 1970. So except for that time, though, nominal GDP was growing at a rate that was faster than 10-year Treasury rate. I think that's important because this period here in the 60s, that kind of built and laid the foundation for what happened in the 70s. And it wasn't until you got here in the early 1980s, 1982 recession, 81, 82, when you finally got nominal interest rates above the nominal growth rate, and this started what was called the Great Moderation, where you had a drop in interest rates and a drop in inflation over the next 40, 50 years. You finally hit the bottom here on inflation and interest rates in 2020 during COVID. So that's what this is. The other two periods I would point out is this one in the mid-2000s. Remember oil prices, 2008 went to $130 a barrel. You had gold during this period, went from 250 to over 1,000. So this, in my mind, was a period of inflation as well. And again, we find that you have nominal GDP growing at a rate faster than the 10-year. This was a period where the Fed was moving very slowly, quarter point a meeting and so forth, and they held that rate below that nominal GDP rate, and we ended up with inflation. The other period is here in this 2009 to 2020, this post-2008 crisis period. Again, we have nominal GDP growing at a rate that's faster than the 10-year rate, and we ended up with inflation out here. Now, a lot of people say, well, that's because of COVID and supply shocks and all these things, and that's true. That's certainly a part of it. But my guess is we'd probably be dealing with inflation today anyway because of what we did here. But I can't prove that, and so there's no reason to really dwell on it, but it is what it is. But here, right here, is why we think interest rates are near a peak. We've got nominal GDP falling, we've got the nominal 10-year rate rising, and they're about to converge. This line right here is 5%, and that's where we think we're going to get rates to converge. Now, look, we're at 4.8 right now in the 10-year, so we're close enough. I mean, 20 basis points is nothing. The point is that's why we think that rates are near a peak, because this is where we're coming to. These numbers are converging. Nominal GDP growth, the 10-year Treasury rate are converging. That's why we think rates are near a peak. Now, look, we can't predict how fast this was going to happen. We didn't know how fast inflation was going to come down. We didn't know how fast the Fed was going to hike rates. So it was always a timing issue. We felt like they would converge. We just didn't know where. Maybe if the Fed had gone a lot quicker, if they had started sooner, maybe we would have converged at 4 or 4.5. But because they waited too long, in my opinion, now we're going to converge at 5, somewhere around there. So let's add in real GDP now. Real GDP, again, the interesting thing here is you can see the difference, the gap between nominal GDP and real GDP. This gap right here represents inflation. So you can see you have big inflation in the 70s, big gap between nominal GDP and real GDP. And over here, same thing. We've got this big gap between nominal GDP and real GDP, but now it's converging. And again, this is why we think that interest rates are near a peak. But we don't want to just want to know where interest rates are going to be short term. We want to think about long term too. What do we think is a reasonable number for a long term treasury rate? What's it going to do over the next decade? Because we're not investing for the next year. We're investing for the next 10, 15, 20 years. So here's how we do that. We can figure out what real GDP is going to be because we know how it's composed. What is real GDP? The change in real GDP is about the change in the labor force and about the change in productivity. Think about it. Labor force, the change in the labor force is how many people are working. So if we add people, number of people working, they should produce more and we should get more widgets, we get more GDP growth. Same thing with productivity. If we have a number of people working and now they're making more widgets per hour, we get more GDP. So you add those two things together and you get a pretty good approximation for real GDP. Now, I want to point this out. These numbers on this chart, this comes from the Bureau of Labor Statistics, and you've got the population growth, labor force growth, and gross domestic product. I don't care about gross domestic product number because I don't care about the Bureau of Labor Statistics guess on that. I don't really care, although it's going to come out pretty close to where we are. But the point is they're very good at figuring out population and, sorry about that, population and labor force growth because they've got all the demographics to figure that out. They know how to do that. So we take this number right here. This labor force growth number is about 0.4 or 0.5, and that's their projection for the next 10 years. Productivity. We don't know what productivity is going to be, but we can look at the range of where it's been and make a guess about where we think it's going to be. So we can look at this going back to the 1950s. We get a 2.8, 2.7 in the 50s and 60s. That's really big productivity growth. Then it falls off in the 70s and 80s, and this is inflation. In inflation, again, chicken and egg, do we get inflation because we're not as productive, or are we not as productive because we have inflation? That's a chicken or egg thing that doesn't really matter for our purposes as investors. What we do know is that low productivity is associated with high inflation. And so in the early 80s, productivity starts to rise again, and the inflation starts to ebb away. And you get 90s and the 90s and the 2000s, you get another rise in productivity. Now, it's interesting. People talk about the 90s because of the internet saying, oh, look how the productivity grew in the 90s. It actually grew more in the 2000s. Why? Well, because you got the internet here. We didn't figure out how to use it until here. So it's kind of interesting. But this number back above 2.5% in the 2000s, that's a great number. And you'll notice here too, this is the post-crisis period, post-2008, 2010 to 2020. That's our lowest productivity rate on this chart. And it also coincides with our lowest nominal GDP growth during that period. So that's not coincidence again. It also shows that we end up with, again, we have low productivity. What do we get? We got inflation. So now this is 2020 to 2023. So it's only 3 years. It's 1.7. It's not bad. It's a pretty good number, but it's only 3 years. We don't know if that's going to last. So what does this do for us? Now we can take our labor force growth, add our productivity growth, and now if we add expected inflation, we get nominal GDP. So where do we get this expected inflation number? Well, we know we can look at the difference between TIPS yields and nominal yields, and we can get an expectation for inflation. Expectation for the next 10 years is roughly 2.4, 2.5. So if we take those things and add them together, we get a nominal GDP growth number for the next 10 years, an average for the next 10 years. And that nominal GDP growth expectation is also our average expected 10-year treasury rate over the next 10 years. So how does this work? Does this actually work? Well, Yeah, look, we're looking at by the decade here. So these are 10-year periods, 10-year averages. So they're not perfect, but a couple of things to notice. When you have a lot of volatility and inflation, these numbers are hard to predict. And you can see what we've got here is this is our workforce growth, this is our productivity growth, this is inflation, and this is that expected nominal GDP growth, the predicted from those factors, and this is what the actual was, and this is our 10-year Treasury rate. So in the 70s, when you had high variability and very high volatility of inflation and inflation expectations, it was hard to predict these things. And this rate stayed below the nominal GDP number the whole time, and you ended up with more inflation. So volatility of inflation makes this hard to predict. But even so, it's pretty close. It's 11 and change versus 10. It's certainly in the ballpark, certainly moving in the right direction. In the 80s, you get lower volatility and inflation, and now these numbers converge. And you also see, too, that you've got a 10-year rate above these nominal GDP and real GDP, or excuse me, nominal GDP numbers, and that kills inflation. That extends into the 90s. Again, low volatility and inflation, you get a pretty good estimation of what this is going to be. The 2000s was a little bit tougher. We had a weak dollar, and we had a lot of variability in the inflation. And again, we end up with kind of a gap here between the expected and the actual, but still not bad. And this is 2010s. And look, here's our nominal growth is 4%, and we end up with a 10-year rate down here around 2 and change. This is, again, a period where we had nominal 10-year rate was below that nominal GDP number. We ended up with inflation. So where are we going to go? Well, if we get productivity, first of all, if we assume the inflation number is going to be right, I'm really confident about the labor force growth number, because I don't think we're going to change our immigration policy, and we're certainly not going to change the number of babies that we're having doesn't seem to be changing. So that's probably going to be a pretty good number. The productivity number is it's in the ballpark, certainly, and we can make some estimates here. The real wild card's inflation. We don't know what the Fed's going to do. Are they going to get this 10-year rate above the nominal GDP number again? Are those things going to converge and the rate's going to go above nominal GDP? That's what it's going to take to kill the inflation. We don't know if they're going to do it yet. But if we get inflation, if we get productivity similar to like we got in the 90s, and expected inflation turns out to be actual inflation, then we're going to get a nominal GDP number up around 5%. If we get productivity growth like we did in the 2000s, which was a little bit higher, we could get a nominal GDP growth of 5.5%. If we go back to where we were during the post-crisis period, we're going to come in at about 4%. So where does that leave us? It gives us a range. If these inflation numbers are right and the productivity numbers can vary, it gives us a range of the average tenure over the next 10 years is 4 to 5.5. That's why we think we're right about where we need to be right now, because that's where the expected inflation is and so forth. So look, we don't know if that's going to be exact. I hope that helps as far as how everybody sees this. That's how we get to these numbers. So anyway, that's what we do. I hope that was helpful, and we'll come back and do some more of these. We've got some other things that we look at. I think the next one we're going to do is on valuation, about how we figure out if the market overvalued or undervalued. So thanks for watching, and we'll see you for the next one.
If you like these videos, give us a thumbs up, subscribe to the channel, and turn on notifications so you'll know when we post new information. You can also subscribe to our free newsletter at alhambrapartners.com/commentary analysis.